Rick Santelli, on-air editor, and frankly, he's holding the whole place up at CNBC. Chicago's own Rick Santelli. Hello, my friend.
Good morning. Good morning, Jane.
Good morning, Rick.
How are you, buddy?
It's good times for those that are invested in the stock market, and I'm sure that many of your listeners have some type of retirement account linked to the equities, and the Dow Jones Industrial Average is on pace for its 12th consecutive higher close in a row. It's already had 11, trading at the highest levels in about 17 months. So that's a good thing.
Yeah.
Maybe what isn't such a good thing, of course, is that inflation continues to remain stubborn, and tomorrow the Federal Reserve will raise interest rates again after 10 consecutive increases. Then the last meeting was a pause. They're going to resume raising rates tomorrow, most likely a quarter point, then pause again.
Well, when do they get to loan shark status?
You know what? I'll tell you, anything above 5% certainly does feel like loan shark status, doesn't it, Steve? Considering that the low in interest rates was well below 3%. Let me think back. February 21, so into COVID, 10-year notes at some point hit, 2.85%.
Right.
They're currently now at 3.92%. Fed funds back then were 0 to 0.25%. They're now at 5% to 5.25%. So yes, anybody who refinanced or had a mortgage down at those low rates, they are very lucky, but they're also one of the biggest problems in the economy right now, Steve and Jane.
Yeah, because obviously you're not going to be interested in refining if you've got a number that's so much better than the number that's out there. There's a volume problem with housing because people aren't moving because they can't afford to buy a new house in this world. I mean, one domino tips another domino. You can't have interest rates that are too low, but you can also obviously have them that are too high. There is no formula for the magic number, but the way the Fed has handled this, where do you fall on the theory that if you ripped the Band-Aid off a year and a half ago and did a 2-point jump out of the gate or something like that, we wouldn't have had this drip, drip, drip go on this long?
You know, there is something to be said for ripping off the Band-Aid and going bigger, more aggressively sooner in the rate increase cycle. I have no issue with that. But to me, if I had to point to the one glaring mistake that our central bank made, it was keeping interest rates too low for too long and starting the increase much too late. They started at March 22. And to me, that is the biggest problem that we have at the current levels of where the economy is moving, because it's been seeded with so much money. And that's the other problem, of course, is COVID. And, you know, I try to be kind. Politicians always like to spend money, but COVID was a horrible chapter in our history, but it certainly green-lighted a lot more spending. And all those trillions of dollars still actually haven't been spent, Steve. And that's what makes me a little nervous, that I think the notion of inflation was created in an exogenous event called COVID, and it's most likely going to dissipate in a very similar fashion. But the problem is that to combat COVID, some of the things we did will change the path of inflation. Just think about all the strikes. No,
sure.
Everybody's asking me, are we going to have a FedEx strike? Well, we've had lots of strikes. We've seen lots of pay increases in many different professions. And many times the economists will look at those wage increases and strikes, and obviously that is going to make the runway for inflation longer.
So does the UPS deal get done this week before the strike?
You know, my own feeling, and this is just my own feeling, is something will get worked out. It really does underpin much of the economy. Think, you know, everybody who gets their deliveries and their Amazons and their Prime, I do think it will get worked out. Now, having said that, there's still going to be a cost to the economy, and it's still going to contribute, because in order to avoid a strike, they're going to have to pony up some extra compensation, and that really is the issue. It's a positive if you're getting the compensation. It's a bit of a negative if you're the Federal Reserve monitoring those wage increases, trying to prevent the economy from staying hot, inflation staying longer and higher than it should.
You know, Jane, you know this to be true, because wherever you go now, you see help wanted ads and crazy amounts of money being paid for what were part-time jobs at the reasonable salaries of maybe minimum plus a certain amount, because they were starter jobs. They weren't jobs that were supposed to be career jobs and so on. And now it is a chicken and the egg theory, but the chicken and the egg, I think, is fairly obvious. When you have to pay so much more money for help, obviously the cost is going to be passed on, and that's part and parcel to why you're paying so much for things as well. So one thing makes the other thing worse. But, Jane, this is our friend Rick Santelli from CNBC.
Well, I know. And, Rick, you mentioned that when we first got on the air with you here about the Dow Jones average being at the 12th highest. If somebody is contributing to an employer-matched 401k right now, is this the time to increase that? Or, if you can, based on inflation, or should you hold back until the economy is better?
You know what? I think always put more in is my kind of back-of-the-envelope advice. And the reason is, of course, that anybody who's looked at the path of equities in any major economy around the globe, for the most part, outside of speed bumps, and there's always speed bumps, whether it's COVID or the crash in 87, the mini crash in 89, the credit crisis, there's speed bumps. But there's also big recoveries. And we never know when the speed bumps occur. So getting in and out sometimes, to me, doesn't make sense, especially if you miss the move when it adjusts to higher levels. So to answer your question, age is the biggest issue. If you're closer to retirement, you want to be less aggressive. If you're not close to retirement, and not close to retirement in my mind would be anybody, basically in their early 50s or younger, should contribute greatly, because that's what's going to hopefully make it so you can retire in a fashion that will please you.
Bonds and treasuries today, what are you looking at there?
I like to continue to look at the yield curve, and I don't want to get in the weeds here, folks, but it's pretty easy. If you were to lend your money to Uncle Sam, Steve, and Jane for 1 year, would you charge more or less if they wanted to borrow your money for 10 years instead of 1 year? What would your answer be?
Well, if they want to borrow more, well, I'd wait for your answer, and then I'd copy.
See, the issue is the longer the duration of you lend somebody money, the more compensation you should get. Yeah. But that's not what's going on. Yeah. What we see now is that the shorter maturities, like a 2-year note yield, are higher than a 10-year note or a 30-year bond. And that's called an inverted yield curve, and it isn't normal. So why do I pay attention to it? Why does anybody listening care about it? Because historically, when the Federal Reserve raises rates, the short maturities get more aggressive. They move higher in yields faster, which is what's going on now. And the longer maturities, like a 10-year note, they get a little nervous because they think the central bank's going to go too far and have to lower rates. So that is why you get an inverted curve. What it's really showing you graphically is that there's a chance of a recession. You raise rates, you hurt the economy. And right now, the central bank doesn't have a problem raising rates so high that they cause a recession, because they think a recession is actually better than persistent inflation.
Well, it's just such an upside-down world in too many places. But we're hopeful for another up day on Wall Street. And, of course, we get our information from Rick Santelli, who knows it better than anybody.
Yeah, almost like an education right there.
Sure. And the good people at CNBC and CNBC.com. Chicago's own Rick Santelli. Next time you're on, we'll talk about whether or not you're buying or selling the Bears.
But, in what town we're going to go see the Bears in, right?
Yeah, to be determined. All right, buddy. Thank you for doing this.
Thank both of you. I always enjoy being on the show.
Appreciate it.